Verizon just reported earnings on Tuesday before market open, and shares open with gap down but currently trading flat as I'm recording this video on Tuesday afternoon. Verizon performing relatively good this year with year-to-date performance of 6.57% comparing to other higher growth tech stocks which are already -30 or -40%. This is relatively good performance, but if we see the maximum performance for Verizon stock, it went basically nowhere from year of 2000 to current years. Meanwhile, of course, paying dividend from 3 to 8% during different time periods. In this video, we'll review earnings of Verizon as well as the market share for Verizon comparing to its main competitors. We will go through the revenue and net income growth as well as answering the question if dividend of Verizon stock is sustainable. We will also go through the debt because Verizon has a huge debt and we will see if Verizon is able to pay those debt. And finally, I will answer the question if Verizon is a buy here and what potential I see over the next 5 years. Let's start immediately from the press release. Verizon Communications said on Monday it lost fewer than expected wireless subscribers in the first quarter thanks to its flexible plans and streaming bundles offering discounted pricing for services such as Netflix and Warner Bros. Discovery Max. So basically what Verizon is doing here, they are partnering with Netflix and Warner Bros. Discovery to build a bundle and add this bundle as a value proposition for the customers, try to reduce the churn. The firm reported revenue of $33 billion for the quarter comparing to the estimate of $33.24 billion as phone upgrades levels continue to drift lower. So Americans, due to this uncertainty because of the tariffs and stuff, they are not actually in a hurry to upgrade the phones. Customers are showing a clear preference for holding onto their phones for longer period amid economic uncertainty and lack of major new features, analysts have said. As I mentioned, as long as we have these tariff uncertainties, people will not be in a hurry to spend money and upgrade their phones every single year. Excluding items, the company reported a profit of $1.15 per share, beating the estimates of $1.12 per share. And also, management is confirming the guidance. We are on track to meet our financial guidance and to deliver positive consumer postpaid phone net adds for the year. This is very good news, is that Verizon at least keeping their guidance. During this particular season, it's very important to see how many companies actually will take back their guidance because of the huge uncertainties because of the tariffs. We have 240% tariff on China, and administration is promising us that deals are coming with Japan, with Vietnam, and so on and so forth. But currently we do not have any deals. So if you are the CEO of any company, it's very tough to predict the future because it's too much uncertainties. And on this slide, you can see the market share for three main telecom competitors, AT&T, T-Mobile, and Verizon. And T-Mobile was taking market share, especially from AT&T. If you can see, the blue line is AT&T was losing market share, especially in 2019-2020, this significant drop. Meanwhile, T-Mobile was taking the market share. But for the Verizon, is not fluctuating too much. So I would not say that Verizon is losing too much competition to main competitors. I would say that AT&T is losing competition to T-Mobile, but for the Verizon, it can hold to its market share. Coming to the quarterly earnings, wireless service revenue of $20.8 billion, just 2.7% year-over-year growth. For adjusted EBITDA, growth of 4%, adjusted EBITDA of $12.6 billion, and free cash flow. Free cash flow is the most important metric for the Verizon report. Why? Because from the free cash flow, Verizon is paying dividends, paying back debt, and also reinvesting into the business. Later we will see from the report, Verizon is heavily investing in capital expenditures because they are building 5G infrastructure for the future. In terms of the operating metrics, wireless retail postpaid phone gross adds 2.4 million and increase of 0.2% year-over-year. Consumer wireless retail postpaid phone gross adds declined 1% year-over-year. Wireless postpaid upgrades, as we mentioned in the previously in press release, that people are not in a hurry to upgrade their phones because of the significant uncertainties in the economy and they are afraid of recession coming. And finally, 45k fewest internet net adds. Now we can see that from the seasonality perspective, the consumer retail postpaid phone net adds in the Q4 usually is a good quarter. because in Q4 we have Black Friday, we have many different kind of promotions and stuff. So finally people are buying phones and subscribing to the plan of Verizon, and that's why here we have a spike. But for the Q1 previous year we lost 194,000 and now we lost 356,000. For the business retail it's more smooth, so it's basically net adds, so this is positive even though it dropped from 80k last quarter to 67k net adds this quarter. In terms of the consolidated financial summary, the company is basically not growing. For the revenue, $33.5 billion is increase of 1.5% year over year. For adjusted EBITDA, a little bit more of 4% year over year increase, and for adjusted earnings per share 3.5% increase year over year. This is one of the most important slide in the earnings report. The Verizon generated $7.8 billion cash from operations and invested in capital expenditure $4.1 billion. As I mentioned before, Verizon is aggressively investing in 5G infrastructure, trying to gain more customers, trying to take market share, or at least do not lose market share to main competitors. But if we can see that in Q1 of 2024 they invested $4.4 billion and now it dropped to $4.1 billion. What does it mean, the drop in capital expenditures? If the capital expenditures will be dropping, the free cash flow will be increasing, and as I mentioned before, the free cash flow will be used to pay dividends, do acquisitions, and also buy back shares, and also pay back debt. So this is very important that Verizon, after stop investing in 5G infrastructure, will be able to pay its long-term debt, because currently the long-term debt is a big problem for Verizon, and also continue increasing the dividends and also buying back shares, boosting the EPS and finally a price of the stock. For the free cash flow, you can see we have increased from $2.7 billion to $3.6 billion. And meanwhile, Verizon paid $2.9 billion in dividends. So basically, we printed $3.6 billion in free cash flow and paid $2.9 billion. So we have another $700 million to pay back debt or reinvest into the business. And currently, you can see from the perspective of debt, in the Q1 of 2024, we have $151 billion of debt, and now we have 143.6. So this is already very good news, is that Verizon slowly reducing its debt. If you're enjoying video so far, please consider subscribing to my channel. On the channel, I do fundamental analysis. I'm running the public portfolio. I'm also recording the educational video about stock investing and compounding your wealth. If any of that interests you, please welcome to join, and we will continue. In terms of the understanding of dynamics of the company and why this company is basically not growing for 25 years, from the perspective of revenue, you can see it's basically flat. For the last 10 years, the revenue grew of CAGR 0.26%, which is basically no growth, flat. And for the net income, the growth is negative. Verizon is paying dividend with the yield of 6.31% and the payout ratio of 51.50%, and 5-year growth rate is just less than 2%, but Verizon was increasing the dividend for 20 years. So the question here is if dividend of Verizon is sustainable, and based on the historical data, currently FinChat did not really update the latest quarter, but based on the historical data, you can see Verizon per year is paying around $10.5 billion, $11 billion in dividends, and meanwhile printing 15, 18, and 19, almost $20 billion in free cash flow. So I would say that for now, the dividend of Verizon is totally safe. Very low probability of cutting the dividend at this point. Another good thing for Verizon is that if you can see, Verizon boosted its long-term debt in 2021. It boosted to $143 billion, and currently it started to drop down. Flat to 133, then 140, and now 123. So the long-term debt is dropping, and also meanwhile the capital expenditure is also dropping. The capital expenditure in 2021 and 2022 was 20 and 23 billion dollars, but currently we can see in 2023 it's less, it's 18 billion and now 17 billion, and it will be probably dropping more and more because the cycle for building 5G infrastructure for Verizon almost finished, and with the less capital expenditure we have more free cash flow to pay dividends, buy back shares, shares, pay out debt, and do acquisitions. The dividend yield for Verizon stock was reaching 8%, almost 9% here, but now the shares rebound and currently the dividend yield is 6%. And in terms of the dividend increase from analyst expectations, currently we have 17. Currently we have a few analysts expecting Verizon keep increasing the dividend, and if you can see, for the next 3 years the dividend will be growing very slowly, but growing. Now the main question is, if the Verizon stock a buy here, and let's see the potential of Verizon stock, which returns this stock can deliver you if you buy it or if you hold it in your investing portfolio. So doing the model here for Verizon stock, we are modeling the revenue growth of around 1.5%, which is basically flat, almost no growth. And finally, we are designing a net income of around 15%, and we do not really expect the net income to too much expansion. So we are projecting net income in 2029 also 15%. And for the PE ratio, we're expecting some expansion because currently the Verizon is trading at PE ratio of 8, but I believe when they reduce their long-term debt and there will be less risk for the business, and also this business is recession proof, and also when the Fed lower the rates, this dividend will become more juicy and more dividend investors would like to invest in Verizon. So I am betting for some kind of multiple expansion from PE of 8 to PE of 10. And finally, we are putting 6.6% dividend yields, and currently Verizon is not paying any buybacks, so we are not putting nothing. So the expectations for Verizon stock to deliver 52% returns over the next 5 years, or 10.3% CAGR over next 5 years, including the dividends and including the share appreciation. If you want to double your money with Verizon stock, you need to buy Verizon at around $26 per share, and in this case over the next 5 years you will be able to double your money with something like Verizon stock. Full disclosure, I do not have a position in Verizon, even though the dividend is high and it's quite juicy, but for me at my stage I'm focused more on the growth. So Verizon is not really for me with 1.5% growth over the next 5 years. This is a stagnating company. This is more for people who is going to retire in the next 5 to 10 years. But for me, the primary goal right now is growing the capital and compounding. So this is not company for me. But if you believe that 10% CAGR is good enough for you, I think Verizon is a buy here. I hope you enjoyed the video. If you did, please consider subscribing to the channel. Recently I recorded a video how to find dividend growth companies using FinViz screener. If you are interested, watch this video next. Thank you so much, friend, for stopping by. I will see you in the next one.